Stock Play of the Day is an educational program. Any statements made by Ally Invest employees are not intended to be or should be considered investment advice, a recommendation to buy, sell, or hold a security, or a recommendation to adopt an investment strategy.
Now, anything can happen at any point in time. And you'll see a lot of activity. Those are the trades that I'm proud of. Hello, my name is Brian Overby. I'm the Senior Options Analyst at Ally Invest and author of the Options Playbook. All right, so last week we looked at a trade in oil. We looked at the USO. We did a very simple speculative trade in oil in that we bought a long call spread anticipating the price of oil to go up. We used an ETF that was called the USO, and we're going to look at that trade today. Oil has came off, and as a matter of fact, it was doing fairly well, and it got a little bit beaten up today. With a strong market. We've seen oil come down, and we're seeing a lot of, in particular, tech stocks rallying in the marketplace. Now, before I go to the USO trade, which we're going to look at an alternative, we'll talk a little bit about how we might approach it. Sometimes it is good when we have a trade that has gone against us because we then can look at how we might adjust it. With winning trades, it's hard to learn from them, and that's what stock play of the day is all about, is trying to learn how we might adjust our option strategies, what option strategies we might want to use in current market conditions. We're in the heart of our earnings season right now, and all the mega tech stock will be announcing earnings this week and next week. So we got a lot of the FANG stocks. Today will be Netflix. We'll be kicking it off. Netflix has rallied going into earnings. Basically, on the news that they're going to go to an ad-based subscription. They're going to lower their level. A lot of people are anticipating that's going to be good for the company. And so it's going to be a highly anticipated earnings tonight in Netflix. That's going to kick it off next week. We got Apple, we got Amazon, we got Google. So we have a lot of these mega cap tech stocks. And that's what's been leading the market higher. The NASDAQ has led the market lower, and now as of recently, we've seen the NASDAQ actually leading the markets higher. Right now, we have the S&P 500 index and the NASDAQ actually up about the same level. SPX is up 0.69%, and NASDAQ is up 0.39%. If you want to get technical about it, the Russell 2000 is actually up the most. They're almost 1%, 0.9% on the day. If we check out the actual VIX, now, I've been talking about the VIX a lot, and ideally, if we go all the way back to August, we saw the VIX hanging in the month of August right around that 20 level, which I'm highlighting on my VIX chart right now, and going all the way back to, this level, hanging right around that 20% level, which was really my line in the sand nowadays between high volatility and low volatility. That was basically drawn after the downturn that was created by COVID. And I was always wondering why, with all these factors in the marketplace, is the VIX actually not showing the fear that I personally had in what could happen going forward with earnings and inflation. Now, we finally are seeing that. We're trading up above the 30 level. We've had very strong markets recently, and we still see the VIX still hanging up above that 30% level. And honestly, I think that that is where we should be. We're still not through October. September proved once again to be a real troubling month on the calendar. For some reason, we just can't seem to get through September and be positive in the markets. And October is usually the wild swing month in that we get big downturns and big upturns. Actually, September is, if you look at the math and you look at the actual historical movements in the indexes, September is usually a more volatile month overall than October. But if you've ever gone back and studied any of the big market crashes, they almost always happen in October. So I never really feel comfortable in the marketplace when we have these economic conditions and geopolitical concerns, and we're still in October. It's just that simple. So the VIX trading at 31.42. It's up a little bit today, and we got an up market. And once again, the VIX is just not dropping. You look at the futures market, the VIX is showing that this volatility is anticipated to continue going into the new year. I don't mind our USO trade. Today is down. Well, let me go and pull up the chart on the USO from last week, and I'll talk a little bit. We did a bull call spread. It was a very speculative trade. And I kind of mentioned last week that it's hard to pick stocks in this market. And if you want to, especially if you want to try to be bullish, we were bearish on the way down in the NASDAQ, as specifically one of the NASDAQ stocks that we did a few bearish trades on, where it was Meta, i.e. Facebook. Also looked at being a little bit bearish in the NASDAQ, but now we're seeing that wild swing back to the upside. So if you look at the trade that we did in the USO, this is a date, well, this goes back, let me grab this chart. Let me look at so this is a 1 month chart, and we went back to last week, and we did actually get a run up above our 75 strike. We straddled the market. We went from 72 to 75. We had a run up to that 75 level. But I did mention on the stock play of the day that if you are doing a long call spread, you want to be right on your forecast a little bit closer to that expiration date. Now we're in this week. We see that the markets were hanging around right about where we were at. When we put on the trade, we were at 71.69. So we just kind of hung in that range. Nothing really happening on the trade. We're long the 72, short the 75. And now we have the pretty big downturn in the market. Okay, so what can we do with that trade? First of all, let's go and look at it. When we look at it inside the Ally Invest option chain. So here's the USO based off of the futures. It's an ETF that tracks the price of oil. Down 176, down $2.79 on the day. Scroll down. The expiration that we chose was October 28th. Basically just because it was the end of October. And on top of it, it was a speculative trade because I didn't have a ton of ideas. The marketplace was nervous. The VIX finally started coming up. Thought maybe with oil actually being one of the commodities that has actually came off its highs, maybe we'll get a little bit of a bounce to the upside. And it's still possible. We still have 10 days remaining till that expiration date. So when we did the initial trade, we bought, and I'm going to highlight here inside the Ally Invest option chains, we have the calls on the left side, we have the puts on the right side. We were bearish. We flipped the coin. We became bullish, on that trade. So we bought the 72 strike call, and at the same time, we sold the 75 strike call. We were 3 points wide. The stock was at, and I'm just going to round off here, 71.70 approximately. We always do the stock play of the day with live markets. So it's always about when you take a capture or a picture of where the trade was at. So 71.70, bought the 72, sold the 75, paid $1.20 at the midpoint. Very good markets in the USO. And because of that, you could probably get fairly close to the midpoint fill, but it's never guaranteed. So that your total risk would have been $120 plus commission for every 1-by-1 spread that you put on. And we're currently seeing it trade at 46 cents. So We've lost more than half of our investment. Half of our investment would have been 60 cents. Simple thing to do is say, I'm going to get out at this point in time. And a lot of people will do that. So we're going to manage our risk on the downside and let our winners run on the upside. And in this instance, letting our winners run didn't help out too much, because by the end of the week, we had the stock at the strike price that we wanted. We had the stock up around that 75 level, and it didn't stay there long. So now we're back down. We're down about 47 cents. I would be totally okay with going in and just trading out of the position. I'm going to give you another alternative. It would have been a little bit better if we would have looked at it at the beginning of the trading day, but now that the market's down, it's not quite as attractive. But I'm going to look at an alternative trade to try to remove some risk, but still keep some money on the table. So in this situation, if we're just going to manage our risk, just get out of the trade and then go look for a different long call spread, we would be doing a sell to close on the option contract that we bought, the October 28th 72 strike, and on the sell to open on that same expiration, we'd be doing a buy to close. Market is at 46 cent debit to the account. This would actually, or credit to the account, I'm sorry. And so I would be closing out that position, hopefully get somewhere close to a midpoint, trade on that, and then just move on. You go on to the next trade. Nothing wrong with that. You're managing your risk. You say, I lose about 50% on the trade. I'm going to get out of that trade. Okay, so here's my alternative trade. And like I said, looked a little bit more interesting in the morning. But let me jump over to the long call. Okay, so we have the long call spread. Here it is inside the options playbook. This is the strategy we were looking at last week. We bought strike A. Stock was right around strike A, fairly close to at the money. Sold a further out of the money strike B, or the cheaper option contract. So now we're going to come back in and we're going to sell another option contract at strike B, go the same distance out of the money and buy the cheaper option contract. And hence, guess what we're going to roll this into? And this is, when you got some time on a long call spread, this is an interesting alternative. I wish I was bringing in a bigger credit, but I still want to show it to you. I still want to share this with you. We're dealing with live markets, so we can't always come up with the perfect scenario, but I do like to look at this adjustment. So when we're all said and done, we're going to have a long butterfly with calls. We take the long spread, we add a short spread, and we end up with a butterfly. We bring in a net credit, we reduce our risk on the trade, but if we get to move back towards our short strike, we still have the potential to be profitable on that trade. So now, ideally, I would like to get a 30 or 40 cent net credit, which might have been possible on the open, but now we're just going to get a few pennies, maybe 15 cents. Let me go and look at that trade. Once again, the markets are open. So let's go back to the chains. And this is our initial trade. So if you put this on paper, which we always recommend paper trades with everything that we're talking about, just so that you can learn using the stuff that we talk about week in and week out on the stock play of the day. And this would be your position in your account. Long the 72 strike call with the October 28th expiration, and short the 75 strike call with that same expiration, down about half of our investment on our 1-by-1 spread. So now we're going to come back in. We already have the sell on the 75 strike call, and then we're going to go up and look at the 78 strike call, equidistant out of the money. Now, if we do that, I'm going to keep it like this, and eventually it's going to roll into a 1-by-2, and I'm not going to add that in here, by 1. That would make the butterfly. But the trade to make the butterfly is only going to be a 1-by-1 spread. All right. Not bad. 16 cent net credit. You might consider it. Right now, you are down on the position about 70 cents, about 70 cents. If I put this position on, I take 16 cents of risk out of the trade because I'm bringing in a net credit to the account. And now I still have a butterfly position on. And if we do get that bounce back up in the cost of oil or the USO, well, if that does happen, I can still be profitable on that trade. So ultimately, if we look at this, we're just going to be selling a short call spread and bringing in a small dollar amount and hoping that the stock comes all the way back to that short strike at that 75 level. So let me go back and put all the positions in. If I was doing this trade and I was considering rolling into the butterfly, I would be watching the short spread. I would actually have an alert on it. I would want to know if the stock was down 2 points, what that short spread would be trading at. Right now it's down more than that. We started at 71.70 and we're trading at 68.22. Do the math there. Come back, we're trying to put this trade on, bringing in a net credit of 16 cents to the account. And so I'm going to put the whole position in. We would have the 72, 75, and 78 strikes available. Okay. Now, in this situation, we would be a 1 by 2 by 1. We scroll down, look at the profit and loss graph now. Did I not add the 70, 75? Oh, I did the wrong one that I added. 77. Okay, we need to do the 78. There we go. So it might have been a little bit better net credit, just a few pennies more, not too much more. All right, 1 by 2 by 1. All right, now we have a nice looking butterfly. Okay, so once we add that short spread, this is what our profit and loss graph looks like. Here's where the stock is at. We're hoping it comes all the way back up to the 75 level, and it's still potential to make $3 on that trade. Now, you have a short spread that's going to be working against you as opposed to just that long spread. So the profitability the underlying has to stop very close to that 75 level. It's a different outlook for the market. We don't want the market to just take off and go to 80, 82, 83. We'd like it to stay right around the 75 level, which is much harder to do. But we're taking a little bit of risk off the table. Gosh, maybe it was 20 cents now since I had the wrong strike on that. And this is what our position would be. And honestly, I would just play the hope game, right? If I just check it out every once in a while, our risk is managed. We've already offset the cost. And if the stock comes back and actually gets within the strike prices, 72 to 78, I'd want to know. Look at it, maybe close out the trade, maybe let it ride to expiration. But in this scenario, I still have a position on. I still have the potential to make the money back on the trade. Another way to look at it is I don't want the cheese anymore. Just let me out of the trap. That's the way I might approach this. But that would be my position. And I wanted to share with you how I would adjust a long call spread that has gone against me. But once again, I would have been much happier if the stock was trading closer to the 70 level, and I would have made this adjustment before we had the fairly large downturn today. Okay, so if you have questions, you can put them in the chat box right now. We want this to be very interactive, and I'm going to get into the trade that we're going to look at this week. And we're going to look at this in the Qs. The NASDAQ has been strong. We have earnings that are coming. One of the biggest concerns and what a lot of the marketplace is going to be looking at is the forecast after earnings. Not necessarily top and bottom line. Numbers should still be fairly decent. I mean, obviously, you never know with earnings, and a miss could really hurt an underlying stock. But what is anticipated and what a lot of the pundits are talking about is what might be the drawdown in earnings going into the next quarter. The consumer is strong right now, but what if the consumer gets a little bit weaker? And that's a lot of the forecasting that, if you will get that from some of the companies, is probably what's really going to drive the markets going into this mega tech earnings week. Okay, so how can we hedge ourselves? I'm going to use options in a different way in that, let's say we're out of the market, and it's got to make you a little nervous if you went to cash. So how might I go and take some of the upside risk of the market out going into this quarterly earnings? So I'm painting a picture here. We had some megatech stocks. Maybe we sold some Apple. It didn't do quite as bad as the actual NASDAQ. So maybe we got out of that position. Maybe I have some cash on hand. But now what do? The markets are starting to come back. One thing that we can look at is actually just buying a call option in the Qs, representing maybe your position that you had in Google and Microsoft and Netflix that you've already been stopped out of or decided to get out of the market on. We have earnings. We're getting to the end of October, getting towards the end of the year. Economic conditions are still not the best. Still, people are still having conversations as to, are we in a recession or are we not? We definitely have negative growth as far as GDP is concerned, and we still have the Fed. They're going to be meeting on November 2nd. They're anticipating, right now the futures are showing that they're most likely going to raise it 75 basis points. So rate hikes are not over with. Just a little bit of nervousness in the marketplace. So here's what we're going to do. We're going to go in and we're just going to look at a simple long call. And I'm going to buy an out of the money long call. Now, I'm not going to do this as a speculative trade. And I haven't used this phrase in a while, but it's more of a fear of missing out. I want to have some exposure to the marketplace, but not a lot, because I'm still nervous about a lot of things. So an alternative trade, which a lot of people might think of, is, let's say I had some Apple and I'm long 100 shares, so I go out and buy one put as we head into earnings. Guess what? You have the same type of profit and loss graph that you do on a long call. You have limited and known downside, as we do in the long call, and I'll highlight it here in the profit and loss graph, and we have unlimited upside. So people might say, why are you buying a put on Apple? Are you bearish? And the answer is no, I'm nervous. If I'm truly bearish, I should just sell it. And that's the way that we're approaching this. We're still nervous about the marketplace, but you know what? We've had a solid run up the last couple of days, and we have earnings coming. Maybe I want to be a little bit bullish. Maybe I want a little bit of exposure to the marketplace. So how are we going to do that? Well, I'm going to run over to the option chains here real quick, and we'll pull up the QQQ, and we're going to buy an out of the money option in the QQQ. Let me find the right tab. 1 second. Here it is. Okay, so I'm going to go out further in time, and if I'm buying out of the money options, which we're going to buy here, I'm not doing it as a speculation thing. I'm going to buy an out of the money option contract mainly because I just don't want to have the exposure of buying 2, 3, 4 option contracts and spending thousands of dollars on these option contracts, because I just want some exposure to the marketplace. The VIX is high, it makes me a little bit nervous. If I'm doing that, even though I might not stay all the way to the earnings, if I'm buying out of the money option contracts as a fear of missing out type trade, I usually err to the side of going further out. So last week we looked at a 14-day trade approximately. This week we're going to look at a 31-day trade. Last week we did a spread. This week we're not. So hence the rationale that's behind the expiration that we're choosing here. So stocks at 271.38. If we look just at the expected move, using the 270 strike, we're talking about, if I bought the call and I bought the put, about a 22-point move. Let's look at the 290 strike, which is about 20 points higher. I'm going to spend $400. I'm going to buy one call option. Now, if I look at this, and I'm really using this as a way of hedging against an upside move, in my mind, if I have a $270 stock and our option contract represents 100 shares, ideally that represents about $27,000 worth of portfolio, cash that I'm not putting in. I'm only spending $400 to give myself some upside, but we have a fairly large deductible, right? Because we're going 20 points out of the money. It's about the expected move by looking at what the long straddle would be. So just understand that it's not gonna necessarily replicate that if you had $27,000 of a gaggle of NASDAQ stocks, but it does give you some exposure and some upside at a minimal cost, and that's what our gain is. So this is going to be the official paper trade going into the earnings week. Interesting way to look at it. We're not really speculating. We're trying to protect ourselves against a strong upward movement next week after earnings, after all the megatech earnings come out. Okay, so our midpoint is $3.95. Real tight market, $3.95 on the bid, $3.95 on the ask. I would just pay the ask. That would be $395 plus commission. That's going to be our max risk. Represents, if you just take the actual underlying price, multiply that by 100, which one option contract represents, gives you an approximation to how much capital that option contract will represent. It's definitely not an exact science, but it just, gives you a little thought about how I want to approach this. Maybe if I had 50 grand in cash, maybe I want to go out and buy 2 of these as opposed to just buying one. Now remember, the concept is that we've already cashed out and we want a little bit of protection against an upward movement in the marketplace. All right. So if you have any questions, let's go check them out in the chat box here. Looks like we have quite a few questions, actually. Appreciate that. Good afternoon. How do you select stock for use for options? Well, so the first question is really about picking stocks. One of the things about picking stocks is that they have to be fairly liquid. Last week we looked at the USO, and a lot of these ETFs, including the QQQs, have decent volumes in them. And you need to have decent volume in the underlying in order to have decent volume and be able to expect decent fills in the options. So liquidity is a big deal. A lot of our option trades within Ally Invest by our clients are done in about 10 to 15 different stocks, and that will probably represent 70 to 80% of our volume, just to keep that in mind. And why is that? It's because those stocks are some of the most liquid. So Apple, Google, the QQQs, the SPYs, the SPYs of the market, those drive a lot of the option volume only because the market is so liquid in those underlyings that you get decent markets in the option trading world. So you might find a stock that you really like. Well, that's all right. They could trade options on it, but if the bid-ask spread on all the options is too wide, well, then you just want to consider trading the stock. Don't trade options just because you want to trade options. All right. Next one. Deb just says, smart idea. Appreciate it, Deb. Can we choose our position when it's close to 75? Can we close our position when it's close to 75? Yes, you can, Deb. So Deb, I think you're referencing the USO spread. So if it gets close to 75, let's say right now it's at 68 and we wake up tomorrow it's at 75. Boom. The downside of doing the butterfly is you won't get rewarded as quickly. You have 2 short options now at the 75 strike. So ideally, you really want that to move for sure closer to the expiration, even more so than we were at when we did the long call spread. But yeah, why not? Why not close it out? So right now, if we sold, we'd be down 70 cents on it. Let's say the market does come back and all of a sudden the spread is trading for $1. All right, well, now we can close that entire trade, add it to the net credit that we brought in, and maybe we get out at break even. Not a bad alternative. Now, once again, I would have liked to brought in a little bit more of a credit, but I think we were getting 17, 18, 19 cents. It's feasible to do it. It was feasible the way it was, even with the market down around the 68 level in the USO. Okay, consumers will be weak summer. Yeah, they could be so this is the concept. Dev is just pointing out that the consumers could be weak, and that would really hurt earnings. So that is why a lot of the pundits and a lot of people are talking about what are the forecasts of earnings going forward into the summer. more so than the actual numbers that the top line and bottom line for the companies. Now, obviously, they come in with bad top line and bottom line numbers. That's going to kill the stock. You can't. It's not anticipated to really be happening this quarter, but that would obviously hurt any underlying stock. So don't try to get cute about it. It's just a lot of people. A lot of people that are talking about the markets and earnings are more worried about the forecast going forward. Okay, debit going up, savings expected. Okay, I love the Apple play. All right, Dev, that's fair. Just buying a protected put, that is one way to look at it. A lot of people still do own Apple, and you just buy a short-term put. Now, if I'm buying a put, if I'm buying a long put going into earnings, I'm really not going to go out that far in time. One of the biggest things is buying puts around earnings are expensive because you have that big event that's happening. So normally, if I was going to buy a put on Apple around earnings, like we mentioned, which was just kind of off the cuff here, I would only look at going out a couple of weeks in time. I just want to get through that known event to make me feel comfortable owning Apple during that earnings event. And I'm actually hoping that my put expires worthless and Apple goes up enough that the stock offsets the cost of the put. If you think about it as a true insurance play, if I own a car and I buy car insurance, most people don't really hope that they drive it into a tree before the policy ends, right? They prefer to have the car as opposed to have a smashed car. And that's the true way that you should look at a protective put on any underlying stock that you might buy. All right, well, a lot of great questions. Appreciate it. Everybody, please share this. Let people know about the stock play of the day. We want to make it an open forum. It's much more exciting for me to be able to address your questions on the show. We'll come back next week. We'll see how the QQQ trade is doing. A lot of companies will not have announced their earnings. Amazon in particular, I think, usually announces on a Thursday. Maybe we'll look at a more speculative play in some of the companies that will be announcing earnings. That's it for this edition of Stock Play of the Day. Smash the thumbs up, click subscribe, ring the bell, and you get all alerts for all the stock plays of the day. Thanks for coming, everyone.